Okay, welcome sir to the video series of financial reportings. The first topic sir that we're going to discuss under this video presentation is regulatory framework. Okay, move to the next slide sir to identify what are the areas that we are going to discuss under regulatory framework. That is topic number 1. Okay, look at what are the things that we are going to discuss under this regulatory framework. First, we are going to look at conceptual framework of financial reporting. So then purpose of financial reporting, so general purpose financial reporting, type of information, so from general purpose financial reporting, primary stakeholders, objectives of general purpose financial reporting, qualitative characteristics of accounting information, general purpose financial statements, objective of financial statements, informations and component of financial statements, elements, recognitions of elements, measurements available for these elements, presentation and disclosures, capital and capital maintenance adjustments. These are the areas that we are going to discuss through this presentation. Okay, move to the next slide to identify what is the meaning of conceptual framework for financial reporting. Okay, move to that. Look at what is the meaning of conceptual framework for financial reporting. According to the given information here, conceptual framework is the basis of general purpose financial statements. Or in other words, we can say basis for general purpose financial statements can be called as conceptual framework. Or in different wordings, we can say the conceptual frameworks lays foundations for general purpose financial statements. Right? It says conceptual frameworks lays foundations for general purpose financials reportings or general purpose financial statements, general purpose financial reporting. Okay, look at what is this conceptual frameworks. You can say basis for general purpose financial statements can be called as conceptual framework, or in other words, you can say foundations of general purpose financial statements can be called as conceptual framework. Conceptual framework. So now we have a really basic idea related to the conceptual framework. If someone asks what is conceptual framework, you should have an answer. You need to say basis or foundation of general purpose financial statements can be called as conceptual framework. Okay, go to the next slide to identify what we have. Okay, that slide talk about what are the objectives or what are the purposes of this framework. Right? Okay, look at what are the purposes of a framework. To help to develop accounting standards, to help to develop consistent accounting policies when no standards applies, to help to understand and interpret the standards. Right? The first things here you need to remember, accounting framework is not an accounting standards, right? Accountants. Therefore, if you need to find accounting treatments related to the transactions or events or some phenomenon, you need to refer accounting standards. You need to refer respective accounting standards to find out the accounting treatments for particular transactions or events. And also you need to remember these accounting standards, the applications available in accounting standards always in front of the frameworks. Therefore, if you have any kind of problems related to the accounting treatments, you need to refer accounting standards rather than the accounting frameworks. Right? Accounting frameworks. Right. Look at first one. To help to develop accounting standards. Actually speaking, the accounting standards are being developed by Council of Chartered Accountant in Sri Lanka. Right? Council of Chartered Accountant in Sri Lanka develop accounting standards, and this framework help them to develop accounting standards. Right? This framework help the councils to develop Sri Lanka accounting standard. That is the first purpose of this framework. The second one, to develop consistent accounting policies when no standards apply. So sometimes we have seen that particular transactions or events or scenario is not explained through the existing accounting standards. Right? And as such, we have to develop some consistent accounting policies to include that particular transactions or events or scenario into the financial statements. Right? Financial statements. For that, we need to have consistent accounting policies. Right? For that, we need to have consistent accounting policies, and this framework help to develop consistent accounting policies when no standards applies. Right? And also to help to understand and interpret the standards. Right? This framework helps to understand and interpret the standards. Actually speaking, if we have better understanding or better idea or better knowledge related to the accounting frameworks, that will definitely help you to understand and interpret respective accounting standards, right? Respective accounting standard. That is what the things are talk about under the purpose number 3. Okay, move to the next slide. So to identify what is general purpose financial reporting. What is general purpose financial reporting? And so here we have so many information in these slides. Therefore, steps by steps, we need to identify what is the meaning of this general purpose financial reporting. What is the meaning of this general purpose financial reporting? Okay, look at reports that provides financial information in commons for primary stakeholders can be called as general purpose financial reporting. What is general purpose financial reporting? Are reports that provide financial information in common, right? Financial information in common for all primary stakeholders. That is what we call general purpose financial statements. And then we need to recognize what are the type of information produced by this general purpose financial reports. General purpose financial reports. Okay, look at the type of information produced by general purpose financial reports. The first one, economic resources. The first type of information that we can see from the general purpose financial reports, information related to economic resources. Second one, claim against the entity. Third one, changes in those economic resources and claims, right? These type of information can be seen from the general purpose financial reporting. Why this general purpose financial reporting produce this information for primary stakeholders? Why these general purpose financial reports produce these type of informations to primary stakeholders? Actually speaking, general purpose financial reports produce information for primary stakeholders to make decision regarding which area primary stakeholders take decision. That is related to providing resources to the entity, regarding which area primary stakeholders take the decision based on the information available in this general purpose financial reporting. They are going to take the decisions related to providing resources to the entity. Okay, again, step by step, identified what is the meaning of this general purpose financial reporting. Okay, what is general purpose financial reports? Reports that provide financial information in common for all primary stakeholders, regarding what area or regarding which area this general purpose financial reporting produce information. It's produce information regarding economic resources, claims against the entity, and changes in economic resources and claims, right? Why these general purpose financial reports produce information for primary stakeholders or primary users of financial statements. That is for making decision. And regarding which area these primary stakeholders or primary users take decision. That is relating to providing resources to the entity. Okay, very simple terms. Okay, in very simple way, what is general purpose financial reports? You can say reports that produce financial information in common for all primary stakeholders, right? All primary stakeholders. What kind of information you can gather having reports, general purpose financial reports? You can gather information related to economic resources, claims against the entity, changes in those economic resources, and claims. And why information provided by these general purpose financial reports to primary stakeholders. That is for decision making. Regarding which area primary stakeholders is going to take decision regarding providing resources to the business entity. Okay, in the next slides, we can identify what is these economic resources, what is claims against the entity, what are the changes in those economic resources and claims. Okay, move to the next slide. So to identify what are the informations available there. Look at type of informations provided by general purpose financial reporting. Here we have identified 4 different types of information produced by General purpose financial reporting. Four different type of information produced by general purpose financial reporting. Okay, look at first one. Economic resources, claims against the entity, changes in economic resources, and changes in claims against the entity. What is actually this economic resource? Here it's a talk about assets, right? When we are going to look at the information related to the assets from statements of financial positions, we can identify how much of non-current assets available and how much of current assets available and how much of tangible assets is there and how much of intangible assets is there, and all necessary information can be taken from general purpose financial reporting related to the economic resources. Here, economic resources means information related to the assets of a business organization. Information related to assets of the business organizations. Okay, look at second one. Claims against the entity. Claims against the entity. What is meant by this claims against the entity? It's a talk about equity and liability of the business organizations. Equity and liability of the business organization. Under equity, you know that we have so many items. What are the items available under equity? We can identify how much of ordinary share capital is there and how much of preference share capital is there, and also how much of retained earning and how much of revaluation reserves and other reserves is there, right? These informations can be seen from statements of financial positions. In addition, we can see information related to the liabilities. Liabilities can be broadly divided into two parts, non-current liability and also the current liability. Information regarding current and non-current liability also can be seen from the statements of financial position. Statements of financial positions. Claims against the entity means providing information related to equity and liability of the business organizations. And changes in economic resources. Okay, you know that during the periods we have additions related to the assets, and also we have disposals related to the assets, and also we have done some impairment loss, and also the depreciations related to the assets. All those things can be identified under the changes in economic resources, right? If you are going to providing information related to the additions and disposals, depreciation, impairment loss, revaluation reserves, or revaluations of the assets, all those things can be identified under changes in economic resources. And the fourth one, changes in claims against the entity. You know that during the periods, sometimes we have issue share and collect the funds, and sometimes we have redeems. If we have preference shares, we have to redeem them, and sometimes we have transfer to the general reserves and the other reserves funds from the retained earnings, and sometimes we have arranged some leasing facilities and bank loan facilities. All those things make some changes for the claims against the entity, right? All those things make some changes for claims against the entity. Therefore, if you are going to provide information related to the issues of shares and disposal of shares, I mean that redemptions of shares and transfer from one reserve to other reserves, and if there is any additional capital introductions, if there is a dividend payment, and arrange some leasing facilities or settlements of the leasing facilities, and arrange bank loans and also the settlements of bank loans, all those things can be identified under changes in claims against the entity, right? Move to the next slide to identify who are the primary stakeholders of accounting information. Okay, look at who are the primary stakeholders identified in accounting framework for financial reporting. So that is existing and potential investors, lenders, and other creditors. These are the stakeholders or primary stakeholders identified in accounting framework for financial reporting. Existing and potential investors. Existing investors means the persons who already has purchased shares and other instruments of the business organizations. And potential investors means the persons who expect to become shareholders or investors of the business organizations in future. Lenders means the persons who provides financials and bank loan facilities and also the financial lease facilities for the business organization. Other creditors also provides goods and services on credit. And these are the primary stakeholders recognized in accounting frameworks for financial reporting. So, okay, look at who are the primary stakeholders recognized in the framework. Existing and potential investors, and lenders and other creditors. Existing investors means the persons who has already purchased instruments from the business organization, and potential investors means the persons who has kind of the intentions to become investors in future of the business organizations. Lenders means the persons who provide persons or organizations provides financial lease facilities and also the bank loan facilities for the business organization. Other creditors means that the persons who provides the goods and services on credit, right? These are the primary stakeholders identified in accounting framework. Okay, move to the next slide. So to identify the objective of this general purpose financial reporting. Okay, with the help of these slides, we can identify objective of general purpose financial reports. General purpose financial reports. Okay, before that, one of the previous slides, we have identified what is the meaning of this general purpose financial reports. What financial reports, which includes financial information for all primary stakeholders or all primary users of financial reports. That is what we call general purpose financial reports. Okay, what is the objective of this general purpose financial reports? The objective of general purpose financial reports to provide information about reporting entity. To provide information about reporting entity. That is the objective of general purpose financial reports. To whom general purpose financial reports are going to provide information? To whom general purpose financial statements are going to provide information. That is for primary stakeholders. That is for primary stakeholders. Who are the primary stakeholders? We have existing and potential investors, lenders, and other creditors. In previous slides, we have identified who are the existing and potential investors, who are the lenders, and also the other creditors. And why these general purpose financial statements produce information to primary stakeholders. Why these general purpose financial reports produce information for primary stakeholders. That is for decision making. And then we need to recognize in which area they are going to take the decision. In which area they are going to take the decision, right? Look at what are the decisions that they are going to take. Buying and selling or holding equity and debt instruments, right? They will take the decisions to buy equity or debt instruments. They will take the decisions to sell already purchased equity and debt instruments, or they will take the decisions related to holding or keep that investments for a longer period of time with business organizations. Okay, the first area they are going to take the decisions of buying, selling, and holding equity and debt instruments. Right. Next decisions that they are going to take providing or settling loans and other form of credit. Right. Providing or settling loans and other form of credit. Other form of credit means financial lease facilities and other type of credit facilities provided to the business organizations. Right. Go to the next one. And exercising their voting rights. Because these existing shareholders, can exercise their voting power at annual general meetings to elect or rejects a team of the managements of the business organizations. Team of the managements of the business organizations. Because the managements of the business organizations take the decisions related to the economic resources of the business organizations. Therefore, if we need to take effective and efficient decisions related to the economic resources of the business organizations, we should appoint the right team for that one. Right, that appointments can be done with the help of these voting rights that we have at annual general meeting. Annual general meetings. That is what the things are discussed about in this third point. Okay, what is general purpose? What is the objective of general purpose financial reports? To provide information for primary stakeholders. Why primary stakeholders need this information? That is for taking decision. In which area they are going to take decisions? Look at it. The first area they are going to take the decisions of buying and selling, holding equity and debt instruments. Second one, providing or settling loans and other form of credit. Third one, exercising their voting rights to elect or reject team of the managements for the business organizations, because it's a very important team of the managements take the decisions related to the economic resources. And this team of the management, unless this team of the management take effective and efficient decision related to the economic resources, and no advancements or no developments of the organizations can be experienced. Right? Therefore, we need to appoint right team of the management for the business organization. For that, we can use these voting rights at annual general meetings. Okay, go to the next slide. So to identify what are the qualitative characteristics of financial information. The qualitative characteristic of financial information can be divided into two areas or two parts. The first one is fundamental qualitative characteristics. The second one is enhancing qualitative characteristics. Under fundamental qualitative characteristics, we can identify three different qualitative characteristics. First one is relevance, second one is materiality, third one is faithful representations. But materiality in between these two, and so therefore materiality can be taken as a part of the relevance. If so, we can say there are only two fundamental qualitative characteristics. The first one is relevance and second one is faithful representations. If someone needs to say relevance and materiality and also the faithful representations are the fundamental qualitative characteristics, that's also okay, no problem at all about it. But you need to remember this materiality become a part of relevance, and so therefore there are two fundamental qualitative characteristics, relevance and faithful representations. If someone need to say relevance, materiality and faithful representations as fundamental qualitative characteristic, it's also okay, no problem at all about it. But you need to remember, well, this materiality become a part of this relevance, right? In that sense, we can say relevance and faithful representations are the fundamental qualitative characteristics. And so look at what are the enhancing qualitative characteristics. Comparability is there, verifiability is there, timeliness is there, and understandability is there. Okay, my dear students, in previous slides, we have identified what are the qualitative characteristics of financial informations, qualitative characteristics of financial informations. And in this slide, so we are going to talk about what are the fundamental qualitative characteristics again. So can you recall what are the fundamental qualitative characteristics? Okay, look at relevance, materiality, and faithful representations. Actually speaking, so this materiality become part of relevance. Therefore, we have just only two fundamental qualitative characteristics, relevance and faithful representations. But we have seen that some people talk about relevance, materiality, and faithful representations are the fundamental qualitative characteristics. Up to some extent, it's okay, but it is not exactly correct, right? Therefore, you need to say what are the fundamental qualitative characteristics. You need to say relevance and faithful representations are the fundamental qualitative characteristics. This materiality become a part of relevance, right? This materiality become a part of relevance. Okay, move to the next slide to identify what is relevance and what is materiality and what is faithful representations. Okay, move to the next slide to identify what is relevance. What is relevance? Okay, look at what are the informations available here. Relevance financial information is capable of making differences in the decision made by the users. Financial information is capable of making difference in decision if it has predictive value and also the confirmatory value of both. Actually speaking, if we have relevance information, this relevance information should have two different values according to the given informations. What are the two different values we should have in relevance information? Predicting value and also the confirmatory value. Okay, we can talk about what is this predicting value and also what is this confirmatory value. Before that, we need to recognize what is actually this relevance, right? According to the given information here, what is relevance? If financial information is capable to make differences in the decision taken by the users, that is what we call relevance. Again, what is relevance? Relevance means financial information. If financial information is capable of making some difference in the decision taken by the users, that is what we call relevance. That is what we call relevance. For examples, right? For examples, like this. There is organization. In that organization, there is engineering departments and also the production department, and also we have marketing department. Engineering department has identified sophisticated technology for the production process, and also they have discussed with the production department, and production department people also agree with the proposal introduced by the engineering departments because they can double the capacity having used new technology introduced by the engineering departments. But before taking the final decision, they are going to have discussions with the marketing department people also. But marketing department people says at the discussions, they are not in a position to increase the sales with immediate effect. There is information given by the marketing department. There is kind of the information given by the marketing department. Because of that information, the top managements of the organization decided to not to introduce new technology now itself. They decided to delay the introductions of new technology for the production process, right? Now what's happened actually? The information given by the marketing people is relevant. Because of that information, we are going to change our decisions. The previous time, production people and also the engineering people decides to introduce new technology for the production process. But marketing department's people says that no, we are not in a position to increase the sales with immediate effect, right? Therefore, the top managements of the organization decide to not to introduce new technology now itself. They decided to delay the introductions of new technology, right? Now what's happened actually? The information provided by marketing department has the ability to change the decisions or make the difference in the decision taken by the production people and also the engineering people. That is what we call relevance. Right? Okay, another examples, right? And financials manager of a firm going to the banks with unaudited financial statements, non-audited financial statements to arrange the loan facilities for their operations, right? But these non-audited financial statements record huge amount of loss. Having seen this huge amount of loss, banking people says, or the officers in the bank says, no, we are not in a position to provide additional bank loan facility for you because you are a loss-making organization for a 3-year period of time. Financial manager gives different kind of justifications to take the loan. But banking people says that they are not in a position to provide the additional bank loan facility for the business organization which are continuously loss making, right? What is the decision taken by the bank? They are not in a position to give the additional bank loan facility for the organizations. After doing year-end audit, they have identified bundle of huge amount of invoices not included in the financial statements. The auditors point out or auditor advise to include that portions into the financial statements. After including these ignored invoices into the financial statements, their loss become a profit. In audited financial statements, and now we have a profit. Financial manager goes to the bank with the financial statements, and now audited financial statements. In audited financial statements, surprise, we have profit. Banking people look at it, investigate it, and they say it's okay. Now we are in a position to provide bank loan facility for you. Now we are in a position to provide additional bank loan facility for you. Now what's happened? The second time, the financial statements produce a relevance information. That is why the previous decision being changed by the banking people. That is what we call relevance, right? If you have relevance information, so definitely that relevance information has a capacity, has an ability to make the difference in the decisions taken by the users. That is what we call relevance. Okay. If we have relevance information in the financial statements, we can identify two different values in that information. What are the values that we can identify related to the relevance information? Predicting value and also the confirmatory value. What is actually this predicting value? Okay, suppose in current financial year, we have revenue of 10 million. Right? Current financial year, we have revenue of 10 million. And also we know that we have estimated in previous financial year, we can experience a 10% revenue growth. If so, for the coming financial year, we should have revenue of 11 million. 10 million plus additional growth of 1 million. So together, we should have 11 million revenue for the coming financial year. if the informations are provided by the current financial year relevance, and also if our estimate is also correct, and we should have 11 millions revenue for the coming financial year. Predicting value. That is what we call predicting value. And what is this confirmatory value? Confirmatory value. If the information is relevant, it should have confirmatory value also. It should have confirmatory value also, right? Current financial year. In these examples, we say current financial year. When we are going to explain this one, so we say in current financial year we have 10 million revenue, and also we are expecting 10% sales growth for the coming financial year. Therefore, we should have 11 million sales or 11 million revenue for the coming financial year. What is look at now this confirmatory value. If information is relevant, it should have confirmatory value also. We are going to record coming financial year. We are going to record coming financial year actual information. When we are going to record coming financial year actual information, it says we have revenue of 11.25 million. 11.25 million, right? Actual information says we have 11.25 million. But in current financial year, we make the predictions for the coming financial year. It should be 11 million, right? Actual one says 11.25 million. Very close one, right? Difference is a very small amount. Difference is very small amounts. Therefore, what's happened? The predictions are taken based on the current financial year information for the coming financial year being confirmed by actual information of the coming financial year. Actual information of coming financial year. Therefore, we can say for current financial year, information related to the revenue is relevant in the financial statements. That is why we can predict the coming financial year. That is why we can confirm that one through the actual information of the coming financial year, right? That is why we say if information is relevant in the financial statement, we should have predicting value and also we should have confirmatory value. Confirmatory value of both, right? Go to the next slide to identify what we have. Look at what is materiality. As I said earlier, materiality become a part of relevance, right? It is not additional fundamental qualitative characteristics. It should become a part of relevance, right? Look at it. Information is material if omitting it or misstating it could influence decisions that the primary users of general purpose financial statements makes on the basis of report, right? When we are going to record the transactions, sometimes we omit some transactions. Sometimes we are going to misstate the transaction. This omitting or misstating make some influences for the decision taken by the primary users or the stakeholders of the financial statement. That is what we call materiality. What is materiality? If you are going to omit transactions or events, or if you are going to misstating transaction or event, that misstating or omitting make some influences for the decision taken by primary stakeholders of accounting information. That is what we call materiality. But here you need to understand well. Can't predetermine amount of materiality. We can't say materiality amount is 1,000 rupees. We can't say materiality amount is 3,000 rupees. We can't say materiality amount is 100,000 rupees or something like that. Which means amount of materiality depends on the situations. Depends on the situation. From one scenario, materiality may be 1,000 rupees. For another scenario, materiality may be 50,000 rupees. 50,000 rupees. Therefore, what is the very important things you need to remember here? Materiality cannot be predetermined, right? Materiality cannot be predetermined. Amount of materiality has to be fixed based on the scenario. Has to be fixed based on the scenario, right? Go to the next slide to identify what we have related to these faithful representations, right? If we need to fairly record or fairly present transactions in the financial statements, right? That presentations should satisfy these sub-qualities or sub-characteristics. What are the sub-characteristics that we can identify under faithful representations? That is complete, neutral, free from errors, right? What is complete? What is neutral? And what is free from errors? What is complete? Complete means when you are going to record transaction in the financial statements, you need to produce all necessary information to understand that particular transaction, right? What is complete? Look at what is complete. Complete means when you're going to record transactions, right? You need to produce all necessary information to understand these particular transactions, right? When you're going to record transactions or balance in the financial statements, you need to produce all necessary informations with the financial statements to understand that particular transactions or balance, right? Otherwise, that is not complete. For example, like this. Suppose a part of our property, plant and equipment has given to the bank as a collateral to take bank loan facility. But when we are going to record this property, plant and equipment, we are not going to disclose that information. If so, we are not complete in the sense of faithful representations, right? In the sense of faithful representations, we are not complete. We are not complete. And complete informations not provided through the financial statements. Not provided through the financial statements. Therefore, balance available under the property, plant and equipment not fairly present in the financial statements, right? Not fairly present in the financial statements. Okay, look at neutral, right? What is neutral? Or what is neutrality? Neutral means you need to record transactions or you need to disclose transactions in the financial statements without bias to any other party. It may be external party, it may be internal party, it may be primary stakeholders, it may be secondary stakeholders or other stakeholders of accounting information. You should not worry about that. You need to produce or you need to disclose the transactions in the financial statements without bias to any parties, right? Without bias to any party. For examples are like this. One of the manager of the bank, rather one of the manager of your firm has taken the loan of 1 million from your organization, right? According to the financials accounting, that should be a related party transactions. But when you are going to prepare your financial statements, this particular amount of 1 million taken by the manager is not mentioned under the related party transaction. Instead, you just mention it as a investments of the business organization. Because of some reason, kind of the biasness is there towards the manager. Therefore, these particular transactions or loans are taken by the manager is not neutrally represents in the financial statements. Right? Go to the pre-prom errors, right? You know that there are so many accounting treatments available for transactions and events in accounting standards, right? When you are going to record your transaction events, right accounting treatment should be given. Otherwise, it's become an error. You need to pick right accounting treatments for right transactions. Right? For respective transactions, you need to pick right accounting applications from the accounting standards. Otherwise, it's error. Therefore, when you are going to record transactions and events and scenarios in your financial statements, that should be recorded free from errors or without any errors, which means that right accounting treatment should be applied for respective transactions and respective events in the financial statement, right? For examples, borrowing cost, according to the LKS 23, the borrowing cost should become a part of cost of the qualifying assets. Without considering this one, what we are going to do, we take this borrowing cost as a part of our income statements. Or in other words, we charge this one to the income statements to calculate profit for the year. The accounting standards talk about different accounting treatments, but we have given exactly opposite accounting treatment for that one, right? Because of that particular transaction not fairly present in the financial statements. That is why we talk about if we need to fairly represent or if we need to fairly present transactions in the financial statements, you need to protect all these sub-qualities that we are going to discuss under faithful representations. What are the sub-qualities that we need to consider when we are going to record the transactions? Complete, neutral, and pre-form errors. Okay, my dear students, move to the next slide. So to identify what are the enhancing qualitative characteristics of accounting information. Okay, look at what are the enhancing qualitative characteristics, right? What are the enhancing qualitative characteristics that we have? Comparability, verifiability, timeliness, and understandability. Okay, what is comparability? The comparability means the financial statement should be produced. Actually speaking, this comparability talk about two different areas, right? Two different areas. What are the areas it's a talk about? Financial statements, the first one, financial statements should be prepared in the manner of comparable, with the financial statements of the same business entity during different financial period. Okay, what is the first area? We need to discuss under? What is the first area we need to consider under comparability? Financial statements should be produced in a comparable manner, with the financial statements of the same entities between different reporting periods. What is verifiability? Verifiability means that the figures and the transactions available in the financial statement should be supported with evidence. Right? Verifiability means transactions and events available in the financial statement should be supported with evidence. Right? This evidence can be collected in two different ways. The first one is direct verifications and second one is indirect verifications. Suppose we are going to do cash count to identify how much of petty cash available at the end of the day. That is the direct verifications. Right? What is direct verifications? Directly we can identify how much of balance there are. And also we have indirect verifications also. Suppose, my dear students, without doing physical stock taking, we are going to recognize how much of closing stocks value. How we can do that one? Based on the cost flow assumption, right? We can use either FIFO method or weighted average methods to assign the value for the closing stocks. And also, another indirect verifications method is there. Suppose a tea manufacturing process, when you are going to introduce raw tea for the process, and we know that weight reduce due to we are experiencing 10% of weight loss when introduce raw tea for the tea powder manufacturing process. And if you are going to introduce raw tea of 1000 kilograms, if you are experiencing 10% weight loss when we are going to take our final output of tea powder, we know that exactly we should have 900 kilograms of tea powder at the end of the process. That is indirect verification. That is indirect verifications. That is being done. That is indirect verifications being done based on the input to the process. Based on the inputs to the process, and in the process we have identified 10% weight loss. 10% weight loss when you are going to take final output. If you are introducing 1000 kilograms of raw tea for the process, definitely we should have 900 kilograms of tea powder, right? 900 kilograms of tea powder. That is indirect verifications. Okay. Timeliness. What is verifications or what is verifiability? Verifiability means the available balances and available transactions in the financial statement should be supported with evidence. Right? What is timeliness? Timeliness means the financial statement should be produce up-to-date information. Rather than the older information. Right? What is timeliness? Financial statement should produce up-to-date information rather than the older information. Right? Sometimes older information required for the decision making. And as such, we need to produce all the informations with the financial statements. That also remember well, right? Timeliness means you need to produce up-to-date information with the financial statements, right? But sometimes all the informations required for the decision making. And as such, you need to produce all the information with your financial statements. Therefore, if that information is older one, you can't ignore it. If it is required for the decision making, you need to provide that one with the financial statement. That is why we have seen earning per share and also the market value per share for a 10-year period of time can be seen in the current financial year. Right? 10 years means 1 decade's back information. 1 decade's back information also can be 10 year. 10-year back information means 1 decade's back information also can be seen in the financial year. That is important to identify the earning trends of the earning and marketing trends of the business organizations. Earning trends of the business organization and also trend of the market price per share of the business organization. That is required. That is why we have seen when we are going to refer financial statements, we have seen that earning per share and also the market price per share being given for the 10-year period of times. Because of those information, even though those information is older one, it is still valid for decision making in the current period. That is why we are going to produce that information, right? What is timeliness? Timeliness means produce up-to-date information with the financial statements. But all the information, if all the information required for the decision making, even all the information has to be produced with the financial statements. Okay, look at what is understandability. What is understandability actually? Understandability means financial statement should be prepared by the business entity in the manner of understandable. For the users of the financial statements. But when you are going to talk about these users should have ability to understand accounting, to understand business operations, and to understand what you call normal economic surroundings. Therefore, when we are going to talk about understandability, what is understandability? Understandability means financial statements should be prepared in the manner of understandables for the users who has sufficient knowledge related to accounting, business operations, and also economic surroundings, right? But sometimes even the user has a fair amount of knowledge or fair knowledge related to the accounting, business operations, and economy. He is not in a position to understand each and everything in the financial statements. Under such, he can get the advice from the expertise. Under such, he can get the help from the expertise to understand financial statements. That may happen, right? Okay, these are the things that we need to discuss under enhancing qualitative characteristics. Okay, with this, I will conclude the part 1 of the presentation. Invite you to join with the part 2 of the presentations. Thank you.